Recording. Okay. Yeah.
Yep. Yep.
So thanks for coming. So today's episode will be mainly based on this GameStop fiasco. So could you
Okay.
just tell our viewers in very simple words the entire sequence of events? So it's like if a non-finance guy just comes and see, he will be
Hmm.
seeing in all the social media feeds and
Hmm.
everything, GameStop and all that memes. So,
Yeah.
so how would you explain it to him?
I'd have to think a bit. It's not an easy job to do, but let me just try. I think most of our viewers understand what call buying is and how that has led to dealers being short gamma and then they hedging themselves in the cash in the futures market. I think that is clear, right? Or should I start even before that? Because the journey actually begins pre-COVID. So pre-COVID, what happened is a lot of people, on Robinhood, on Wall Street bets. Robinhood is basically their broker. So they went and did a lot of irrational call buying.
Okay.
Now, the market was never like this before. So, in the options market, it is entirely dominated by market makers who are ready to fulfill any orders that a retail client or institutional client wants. So, what they do is they sell or buy options according to the institution or retail client's requirement, and then they hedge themselves to avoid underlying exposure. If you ask how
Okay.
they make money by simply of the bid ask spread, and they also get a some kind of a commission from the exchange for getting a trade done. So the exchange is actually paying them so that there is liquidity in the stock options market. So what happens is uh, I'm calling this irrational call buying because people went in and started buying call options for no reasons. And when they buy call options, the dealers who are actually selling them hedge themselves by buying futures or the underlying stock in the cash market. So whenever somebody sells an option, they are basically called short gamma because they have short gamma exposure. And short gamma can be very hedging for short gamma can be very dynamic process. Users will these market makers will have to go and hedge as the gamma of their position increases. And irrational call buying meaning I come today and buy some OTM calls, then I go again tomorrow and buy some OTM calls. OTM meaning out of the money calls, and this basically intensifies. And on the other side, the dealer is actually accumulating a lot of short gamma, and he keeps on buying and the price goes up. And at the same time, retail also became active post COVID. They started buying into the dips of the stock market, and prices kept going up and up. So before even we talk about GME, we have to talk about Tesla, because Tesla was
Okay.
one of the gamma squeezes or short squeezes in history, because it happened in March and June. A lot of it is just because of the gamma squeeze, and Tesla was also one of those stocks that had peaked, short interest.
Okay.
So, knowingly or unknowingly, I'm meaning Tesla is an even bigger company. It was a $40 billion company when short interest was at. I think I'm not sure about the numbers, but it also had significant short. Its free float was also composed of significant short interest.
Uh,
So it was one of the gamma and
yeah.
short squeeze.
Yeah. So
Yeah.
just to make things clear, it's like the option maker before he was selling the call option, sell option, he wasn't having the stock. So once he
No,
sold,
it wasn't.
oh, so okay. So once he sold the option, he had to buy the stock.
Yeah, because he doesn't want underlying exposure. He doesn't
Yeah.
see the option may end up in the money or out of the money. He doesn't
Yeah.
want any
Yeah.
such exposure. So by hedging
Okay.
with the stock, he's just nullifying that effect.
Okay. Okay.
And
Uh,
this process is
but
dynamic.
he
Yes.
has to do it, right? He has no other option.
Yeah,
Like if
he
if
has to.
you're
That
going
is
to
his
sell,
business model.
yeah. So if you're going to sell an option without buying the stock, like call or
Hmm.
sell option, then you have to buy
Hmm.
the stock to hedge yourself because you might lose to the person who's buying the option from you, right?
Yes, only the market maker, not necessarily
Okay.
with everybody.
Okay.
Yeah,
Okay. Not the
because this is
retail
the market
investors, only the
maker's
market
model.
maker. Okay.
Yeah,
Okay.
because this is his business model.
Okay. Okay.
Yeah, yeah. So the same thing happened with other tech stocks and cult stocks.
Okay.
We saw similar all over tech and these cult stocks like GME and stuff.
Yeah.
On the other end, hedge funds were doing a thing of their own, especially
Okay.
these long short hedge funds. They were running some of the highest gross and net leverages to record
Okay.
highs, and in the US hedge funds can get unlimited leverage. Yeah.
Okay.
So they were running these big, record high gross and net leverages, and there were major imbalances that was, bringing the whole market close to a major deleveraging event even before Wall Street bets came around and hit the final nail in the coffin. So hedge funds
Okay.
were doing a thing of their own. They were taking lots of leverage and they were building big short positions in certain stocks where nobody was looking, and prices were going down a tad bit.
Okay.
But if you look at a year to June, one before January 22nd, 2021, the most shorted and next most shorted stocks had gains of 25 and 20%. So hedge
Okay.
funds were actually shorting these stocks, but despite that, there was some minor short squeezes that were actually sending these stocks back up. And so hedge funds basically use such positions, as I also mentioned in the group previously. What they do is uh, they want to build high Sharpie portfolios. That is their goal. Okay, so
Okay.
sometimes to generate uncorrelated returns, they use such short positions. And GME, AMC, Build a Bear, and American Airlines, and some REITs. They were all these stocks that hedge funds were having massive short interest. GME, in fact, had 140% of free float as short interest, which is
Yeah.
outrageous.
So what does that mean? Like, how can the float be 140% of the free float? Like, how can the
Yeah,
short interest be? What does that mean?
it means that 40%, the excess 40% had no backing at all. So they those positions, if they were open, they had to get closed. The problem with the system is there is no limits. So you could go to 140,
So
you could go to 200, nobody would
so
even give
what
a.
isn't that illegal? Because 40% has no backing means there is no stock, right? In the
It's
free
not illegal
market.
because it's not stipulated according to the law. Meaning there is no provision for stuff like that. A
Okay.
stock can have, yeah, there is no such provision anywhere. That's why it's 140%.
But it should be illegal, right? Like if you look by common sense.
I can't call it illegal or illegal because at the end of the day, it's free float, and everybody has a different definition of free float. Some
Okay.
promoters also keep exchanging equity. It becomes part of the market free float sometimes. They have
Okay.
different definitions of free float. What the SEC might consider as free float may not be free float to these hedge funds and retail clients.
Okay. Okay.
Yeah, yeah.
Because in
So
some definition, the stock with the promoter is not in the free float because that's not there for trading. Then you have
exactly,
mentioned
exactly.
that suppose if the promoter pledges his stocks with a loan, in a
Yeah,
way you can call that as a free. So it's subjective, not objective. Is that
it's
yeah?
yeah, it's subjective. Plus, there are no restrictions. Okay,
Okay.
everybody's crazy. Yeah.
Okay. Okay.
Yeah.
Okay.
So now coming to GME. So what happened with GME is GME is one of those heavily shorted stocks. Okay, with 140% short interest. The free float was 140% of short. Sorry, the short interest was 140% of free float. So
Okay.
it quickly became a stock with a massive cult following on this Wall Street bet subreddit on Reddit.
Okay.
So what happened is people started buying initially. Okay, the trend began and prices started rising up. And when it was at the point of $36 to $37, I think it was Citron Research that came out and said, this, people are buying right now are kind of suckers at this poker game. So the
Okay.
stock,
Okay.
and they said they were going to short the stock and they gave a target for $20.
Okay.
But the
Okay.
next day, this massive gamma squeeze began. Okay,
Okay.
call options were being bought left, right, and center. Dealers were buying stock to hedge their short gamma,
Okay.
and suddenly a lot of buying back from short sellers also started because prices were going up, and that triggered a
Okay.
full blown short squeeze. So
Okay.
what happened is GME went up in prices. Short sellers started selling, and a lot of call options were bought. I mean,
Okay.
last Friday, 913,000, meaning 9,13,000 call options were bought in the United States.
Who are these
Uh,
people who are selling these call options? Yeah,
market
but
makers, market makers are the ones who are
okay,
selling it.
okay, okay. Market makers. Yeah. Okay. Okay.
Yeah.
So now they will
So
also be
that
buying
is the kind
GME
of stuff.
stocks. So they'll also be buying GME stocks again, driving the price higher, right?
Yes, yes, and
Okay.
even not just them, even Wall Street Bets was buying stocks.
Okay.
They generally option guys, but even they were loaded heavily on stocks.
Okay.
And we all heard about what happened to Melvin Capital. It had a big shot on GME, and it blew up.
Okay.
And Citadel and Point 72 Asset Management came in, put $2.5 billion, and somehow saved the company. And
Okay.
maybe that was I think that was an SEC-led intervention to actually stop
Okay.
a big domino effect from happening. Yeah.
What domino effect would that have been? Like if
I mean, see, hedge funds are basically these leverage enhanced investment vehicles. So they're not going in
okay,
with their money. They're going
okay,
with bank money. Some of them are primary dealers in the open money market where the Fed does its repo operations. So a lot of
okay,
money is coming from different places.
okay,
Yeah.
okay,
So if hedge funds are going down, it's not like the retail guy going down. When we are going down, we're going more or less on our savings, right? So
okay, right, right.
still, if we have a job, we can still make our ends meet. But when
Yeah.
such big leverage enhanced hedge funds that were already running the highest gross and net leverages to date, when they're going down, then that's going to result in the end game. There will be a big domino effect, and uh, governments will have to
Like
go in and bail
like
banks
the
and hedge
Lehman
funds.
Brothers, right?
Lehman Brothers is again a different case.
Yeah, it is a
They had
different case, but it would have led to a domino effect to
Yeah,
that
it would have,
effect.
maybe,
Yeah,
because
yeah.
Lehman Brothers had shit loads of, these mortgage-backed securities that they were not able to unload, and that caused
Okay,
a big liquidity constraint, and the firm had to file for bankruptcy in the end. Yeah,
okay, okay,
yeah. So, Melvin blew up, and then this also spread to the broader market and global markets. Okay, because
okay,
hedge funds were actually liquidating positions in other stocks so that they could keep up with their losses in GME and the margin requirements in GME. Because after this kind of ban that happened recently, a lot of short interest came back and came back into the stock. Some short interest went by some 61% or something. So
what does that
they,
mean? What do you mean when you say a lot of short interest came back?
I mean, before the ban, some funds could have anticipated or could have got insider information, and they came and they again started building short interest because the stock was already about 200,
Okay,
and
okay,
this stock was worthless in their sight. So they came and built their position again, but that still didn't stop. Okay, it went to 400,
okay,
500, came down to
okay.
300 or something.
Yeah, yeah.
So broader markets, as I said, and funds were liquidating their positions and to keep up with these stock and losses and margin requirements in GME and other bunch of stocks that I initially mentioned.
Alright.
So
Yeah, so
yeah,
basically what you're saying is like when the stock like after this hedge fund, this Melvin Capital and Citron Research had to close down, many hedge funds saw that okay, now this is the right time to short because fundamentally it's still a bankrupt company. So
yeah,
they went,
fundamentally still. So they
so
kind of
this,
kept on adding to
okay,
their loss-making positions. Yeah,
but still it didn't make any difference. It just went going up.
yeah. Still, it didn't make a difference because despite the ban, I think GME is right now trading at 325. I'm not sure about the pre-market quote, but
Okay,
the right now trading actually closed at around 325 with a $120 gain.
okay,
Yeah,
okay, okay.
that's what's happening with GME right now.
So
So this resulted in a big global deleveraging and degrossing event. Okay, and
okay,
this whole scenario could have panned out in a different way, but what I see, the base, the root of all of this is irresponsible fund leverage.
okay,
The guys, smart retail guys were just the pin. It could have been anything else. Okay, it's not necessary that it could have been this particular thing, but it could have been anything else. The main thing is hedge funds shouldn't have run their positions on massive amounts of leverage.
what is the
Irresponsible fund
average?
leverage is something
What
that's.
is the average leverage amount of a hedge fund?
I'll have to look that up, but I'm guessing easily about 3 and 5. They can go
Oh,
3x, 5x of capital pretty easily. In India, it's only 2x. Category 3 alternate investment funds,
okay,
cannot go more than 2x of their capital.
okay, okay. So that
Yeah,
goes
so
to 3x, 5x. Okay. Uh,
easily that is like a small thing for them. Yeah.
yeah, another question which has been doing the rounds in LinkedIn, especially, is can this same thing happen in India? And people are saying, let's do it for Yes Bank and Vikrangi stock. So, can such a thing happen in India
Okay.
also, where a bunch of traders decide to coordinate in a Telegram or Discord thread and
No. Impossible, impossible. You know why? Because India, I think Nitin Kamath had put an amazing
yeah,
out. You cannot have more than 5 times leverage overnight for overnight positions, man. Okay, and that
okay,
leverage is again calculated in a very complicated manner. Okay, for
okay,
FNO, for futures and options, they check the span plus exposure margin. And then sometimes when volatility is high, these numbers go really up. And for stocks, it is the value at risk and the ELM ratio. So that is also a very big number.
Okay.
So you cannot even lever your position more than 5 times overnight. That is the first
Okay.
thing. So leverage is
Okay.
highly, and intraday leverage. Forget about overnight. Intraday leverage recently, they cracked a lot down because Asta broker was offering 40x leverage
Oh,
in
okay.
India.
Oh,
Okay, even that got capped, and now it's all down to the 1 plus ELM.
okay.
So that's one thing, and that's the first thing. You cannot take excessive leverage to amplify your position. And the second thing is nobody can have an undue influence in the Indian stock market because. We have to be grateful to SEBI for that because we have a position limit of 20% on free float in both in both FNO and stock lending and borrowing scheme, and the
Per
maximum
uh,
client is
so that is
about
for the yeah. Sorry for interrupting. That's for the entire stock. 20% limit.
yeah, that is for the entire firm. Yeah, 20%. Yes, I mean if it goes above that, it comes under the trading ban. Yeah.
Okay. For example, if I want to like short 5% of the free float, and you want to short
Hmm.
5% of free
No,
float,
no.
so
Again, the
five,
max OI per yeah.
so
Again, the
five plus
max
five
OI.
10.
Yeah, that can happen, but the max OI per client is 1%. That's
Oh,
another short.
okay. Okay, that's
No,
another
no single
restriction.
player. Yeah, no
Okay.
single player can dominate the market like that.
Okay.
Yeah.
Okay. So,
Just a second. I'm getting a call. Just a second.
yeah,
Yeah.
yeah, yeah. Another
Yeah,
question that
yeah,
just
yeah.
came to
Sorry. Yeah.
mind was
This
the
the screen is
Robin Hood.
getting blurred in between. Yeah, fine.
Yeah, yeah, I think we'll have to edit a lot. Yeah.
Hmm.
Yeah. Another question that just came to mind
Okay.
was
Okay.
regarding the Robin Hood business model. So, from what I read,
Okay.
they said
Okay.
that they don't charge for any of the trades and all. So, then how do they make money?
It's quite simple here. See, what happens is now one way. I'm not sure if there are other ways, but one very controversial way how they make money is, through rerouting their trades. I mean, traders put in trades on the system. So what they do is they have the option to direct those trades to whichever market maker or the open market they like. So what Robinhood does is this is basically called the order flow. So who gets what? So what Robinhood does is Robinhood, redirects its order flow to Citadel Securities, and Citadel pays it a fee to actually, get these orders from Robinhood. So last year in the second quarter, Robinhood made a net income, a total income of $180 million, and about $111 million came from these zero commission option trades, which were basically rerouted to Citadel. Which is
So,
a
what
market
is
maker fund.
okay? Okay, Citadel is a market maker.
Yeah, and also a hedge fund. That is what's the
Okay,
interesting thing about it. Yeah.
okay,
So that is their primary business model. Where they get money is mostly they get money out of payment for order flow. Yeah, 80% or 85% of their revenue coming from that source.
okay.
That's how they make money. Yeah.
So, what does like rerouting mean? For example, if I want to buy a Tesla stock on Robinhood, right? So,
Yeah.
how will they reroute it to an
It's not
option make?
like rerouting. I think I used wrong word, but the order is fulfilled in such a way that Citadel does it. Tesla stock is not a good example. Let's take Tesla call option. You want to buy a Tesla call
Okay,
option, and
okay,
the market maker is the one who has to sell it.
okay,
So now, if Citadel wants to fulfill that order, it pays Robinhood a certain commission.
okay, okay.
Yes, that's how it is.
Okay, so so in other brokers, like how is it?
Even
Like
other brokers have similar business models. Okay, meaning, but the extent to which it's happening in Robinhood is very different, because all this irrational call buying mania by the retail is happening on this one single platform called Robinhood. So
okay,
in other brokers also it's happening, but not to the extent at which it's happening with Robinhood.
okay.
Yeah.
Another topic which came to my mind regarding like after this fiasco was community-based investing and the role of
Okay.
social media.
Okay.
So, Elon Musk had once like remarked that one who controls the means controls the world, and
Mm-hmm.
of course that time many people had just laughed it off. But yeah, when you look at these, it's look like these millennials who just all day share memes and have these $2,000 stimulus checks. Took down an entire hedge fund consist of Ivy
Yeah.
League and I mean, there were many prestigious investors also. I think like Jim Chanos and all, who had a very good track record. But in this case, they just drove them to the ground.
Yes,
Of course, they
yes.
were bailed out. So, how do you think this affects this community-based
Mm.
investing, where social media like Reddit, TikTok, and all impacts? Yeah.
Yeah, from whatever happened, yeah, yeah. So from whatever happened, it's evident that it could be devastating. Okay, yeah, that
Okay.
that is one thing that I clearly see. It could be devastating because and also illegal to a certain extent because this is they're coordinating in the out there open in the public. Okay, sometimes hedge funds collude among themselves before they short a stock and all, but there's no real evidence that they did it. But these redditors are being juvenile by collaborating or colluding out there in the public on the subreddit to pump prices up. So there will be some kind of restriction on that. But if it goes unchecked, it could have some serious and devastating effects because all they had to do is go buy calls and trigger a massive rally, and people will eventually start buying into it. So it is that simple for them, us and some people in the community, like a lot of people in the community. I'm not going to name specific people because again they're all usernames.
Okay.
So yeah, they have significant amount of influence on how the stock market can move. Okay, suddenly
Okay.
overnight they more powerful than guys like Warren Buffett, Ken Griffin, who've been
Okay.
there in the market for years. They just have to put out a stupid Reddit post on a stock they like, and users will start buying it. So that can have
Okay.
long-term adverse consequences. You can't have these shitcos or zombies being like 100 and 200 billion dollar companies in the market, right?
Okay. And
Yeah.
like in the previous episode, like you said, fundamentals they follow prices. These will actually even affect things on the main street also, right?
It is, I mean, that is right, but we cannot stretch it that much. That I believe, no way GME can actually prove a $30 billion valuation in 5 years because the company has got no plan to do it. Now, reason I feel that with Tesla fundamentals will follow because Elon Musk has a plan. The company is positioned in a way that
Okay.
it wants to go and become one of the largest car manufacturers in the world. It wants to become a leading EV tech company. That's how it's positioned. But overnight, even the CEO, the executives of the company are shocked that their stock is going up. They're not ready for anything of that sort. Yeah, so this is just pure bubble mania. I don't think so. We'll see fundamentals following the price here. It's not going to happen with every case. A lot of inefficient, capital allocation is going to happen. That's it.
Okay.
Yeah,
Okay. No, regarding like you said, certain people, just post a
yeah.
tweet on a stock. Even Mia Khalifa, she has posted, I think, on Dogecoin, and that's a very good point that you made. That it's like
Yeah,
earlier these people they used to talk on like on politics, and people used to rally around them. Now they have like earlier it was anti-Trump, right? So and
Mm,
they used to say a tweet around Trump, and then they'll have millions of followers.
mm,
Now it's on stocks, and the problem is now people's
mm,
money is on the line. For example, from what I see regarding this Jamie, okay, right now the stock like as you said is 350, but fundamentally it has to go down to $30, right? I mean, it goes down to $30, then who will bear the brunt? Obviously the retail investor, the people who are you
the
know
retail investors,
yeah,
yes.
people right now are saying that yes, they this is a class warfare against the rich. I mean, the rich, they got bailed
Mm.
out. They got a government, indirectly government sponsored bailed out. But yeah, when this
No, no,
thing
yeah, yeah, yeah. Go ahead, go ahead. Yeah, sorry,
Yeah,
yeah,
yeah. So directly they got a government sponsored bailed out, but when this goes down to its intrinsic value, these guys will be hurt.
yeah,
But
yeah.
yeah, it sends a signal to many other companies also. Like, why build a business with a strong moat when you just has to pay money to a porn star or to any influencer?
Maybe even become a meme. But I want to come to the point where you mentioned about a government bailout. See, I think it's a misconception that's out there, and I think we need to clear that. It was not a government bailout. It was 100% not a government bailout. On
Okay.
Twitter, I was also reading the fact that Ken Griffin had called Janet Yellen, to stop this big before shit hits through the roof.
Yeah.
But then it's not like that. Under the Dodd-Frank regulations, there is this DTCC, yeah, Depository Trust and Clearing Corporation, and they are the ones who actually who actually ask for collaterals from brokers because they have a T+2 settlement and clearing mechanism. So they need some collateral or some kind of a deposit with them so that they can continue doing business, and they are the ones who actually demanded an increase in margin and collateral from Robinhood. So, and why did that happen? This was not because hedge funds were to be saved by the government, but that's just simply how the DTCC works under the Dodd-Frank regulations. Now I'll tell you. I'll give you an example. Okay, so Robinhood is a brokerage firm with lots of financial requirements. Capital requirements and clearinghouse deposits. So now these deposits are actually based on conditions like market volatility, and stuff like, and because in the current environment, everything was substantial. There was a lot of activity in certain strikes or certain names. Like there was concentrated buying activity in the select bunch of names that we discussed, and market volatility was also at high. The VIX was about 30. So
Okay.
now, in such situations, what these clearing houses do is they require for more margin and they require for more collateral. So what happens is now the talk on the street is Robinhood had liquidity problems when it came to that fact, because they couldn't continue it because users' orders were increasing, and also the volatility was increasing. So the deposits that were actually linked to them also increased in value. So Robinhood was not able to keep up with that, and that's why it actually had to stop trading. Meaning the users could still sell, but they couldn't buy in those 12 names. That is
Okay.
what actually happened. Okay. Now Robinhood
Okay.
says that it did it preemptively, to stop something, or it did it proactively. But I don't think so that was the case, or it was anything that was done like that. It
Okay.
was clear that Robinhood was facing a problem, and this could be a problem with any broker that this crowd is going to. They might not be
Okay.
able to keep their buying. Yeah.
Okay. So if I've got it right, like because of the multiple trades, Robinhood didn't have the money or the cash to
Yeah.
backstop all those
Yeah.
stock
So
by.
with clearing houses, yes.
Okay. Okay. They didn't
Yes.
have that much money quickly to
Yeah,
execute all
volatility
those
was
trades.
high, and the number of trades that these guys were doing was also increasing on a day-to-day basis. So,
Okay.
the clearinghouse, what it does, according to the Dodd-Frank regulations, it goes and asks for more collateral or increases their deposit limit.
Okay.
So that has to be deposited by the trader, or or by the broker, or
Broker.
they face
Okay.
penalties or stuff like that.
Okay.
That
Okay.
happens. So either they had to restrict trading or increase the money that they deposit with these clearing houses, and that's
Okay.
where I think a real liquidity issue propped up.
Okay. Okay.
Yes, yeah.